Welcome to the AIB Access Africa YouTube channel. We are so excited to have you here with us today. And today I have a great friend of mine, Gloria. Welcome, Gloria.
Thank you.
So happy to have you here.
Yeah, I'm happy to be here.
Yes, so today we're doing part 2 of the Fireside finance charts, and we'll be talking about alternative investment options. What are they and why should you know about them? Gloria, you represent everybody out there who has questions about alternative investing and how to make the most of it. Feel free to cut in at any point if there's something that you need clarification on. So if you want to know about how to make the most of the money in your pocket right now, stick around.
So you did say that today's topic is alternative investments. What are they and why do I need to invest in them?
Great question. When it comes to investing, it's important to understand that first you need to understand the basic principles before you work your way up to more technical processes. So let's start with what an alternative investment is.
Okay.
So within the Kenyan context,
Yeah.
and we'll stick to the Kenyan context,
Mhm.
these are investment options that are not typical to the general wananchi.
Okay.
So we all know about savings accounts, we all know about money market,
Yeah.
we know about SACCOs, real estate, but we don't know about other alternatives like bonds, bills, derivatives, even stocks,
Yeah.
or as we call them, shares. So those are the ones that we'll probably chat about today. To answer your question on why it's important to use alternative investments, it's because as an investor, you're trying to achieve a certain amount of return while controlling your levels of risk. Or rather, every investor is trying to maximize their levels of return while minimizing the amount of risk that they take on, right? And these investment options enable you to manipulate your portfolio to achieve that objective. An additional benefit of understanding alternative investments is that they enable you to have a well-rounded portfolio. So as investors, we have all sorts of needs, and sometimes only understanding the traditional asset classes limits us. So for example, maybe you need some assets that will enable you to convert them into cash quickly, if for example it's an emergency,
Yeah.
or you will need a regular income from other investment options, or you just need abnormal returns because there's something that you're trying to achieve in a short amount of time. By understanding the investment options out there, you'll be able to have an ideal portfolio that suits all your needs.
Okay. Now I understand what alternative investments are. Could you give me some examples in our context here in Kenya?
So the alternative investment options that we'll consider today within the Kenyan context, when I say alternative, means stocks, bonds, and derivatives. And before we even move on, it's important to note that these alternative investments should not replace your traditional investment options.
Okay.
They just give you a better portfolio, an ideal portfolio that's more suited to your varied needs.
Okay.
Let's start with the less risky investment options like bonds. There are two kinds of bonds, corporate bonds and government bonds. But before we even go there, what is a bond and how does it work, right? A bond is basically, let's say it's a government bond. A bond is basically a loan that you're making to government. So government has different aims. Maybe they want to increase infrastructure, so then they release an infrastructure bond where they take money from the public, essentially it acts like a loan, and they pay you back interest payments for a certain period of time, and at the end they return to your original investment. So it literally looks like you made a loan to the government. And the reason we call it an investment is because your money has grown during this period of time through the interest payments, right? That we call coupons.
Okay.
So for example, if you gave 1 million shillings to the government and you are earning 13%, that would mean you receive 130,000 shillings as an interest payment. So at the end of that period, your money has grown 130,000 shillings. So that's why it's an investment for you and a loan for the government. Let's get into your need for this investment. So now you understand how it works, fair enough. But why do you need this bond in your portfolio?
Yeah.
And one of the benefits is that you gain a higher interest than you would on, say, other less risky investments, like for example, your money market.
Yeah.
So your money market interest range would be between 7 to 10%. But your bonds, you see, I mentioned 13%, 14%. So it is higher and quite low risk.
Yeah.
Another thing that I have to reiterate is the low risk. So government bonds, for example, are considered risk-free. So the likelihood of you losing your money in a government bond is 0 to none. So in terms of your portfolio, it's a bit of a safety net for your cushioning you against your other more risky investments that you've taken into your portfolio. And the last benefit that I would mention is the regular income payments. So depending on your obligations that are coming up, let's say school fees or perhaps pension, you want some sort of pension income, you're coming close to your retirement, or I don't know, there's something that you want to achieve in the future that regular income payments will help you to achieve, then you'd want to put your money into a bond.
Where would I get information if I wanted to invest in bonds?
Okay, all right. So if you wanted to invest in bonds, you'd reach out to a brokerage house like AIB Axis. We'd guide you in what bonds to invest in, what are the fees, and just how to go about the entire investment. We'd hold your hand step by step.
Okay. I also heard you mention shares. What are those and why do I need to invest in them?
Okay, great question. I did mention stocks and or shares as Kenyans call them. So once you have a portfolio of investments, you should include shares in order to have a well-rounded, ideal portfolio, because shares do have their unique benefits. And how do you benefit from shares? Let's even start in terms of return. Once you buy shares, you are termed a shareholder. And that means that, first of all, you can gain from price changes of those shares. So, for example, if you buy shares at 10 shillings and then they grow to 20 shillings, that means when you sell them at 20 shillings and you bought them at 10 shillings, the difference of 10 shillings is just a profit that you've made.
Okay.
Correct?
Yeah.
Another means that you can make money off shares is through dividend payments. So I mentioned before that you are now called a shareholder. And as a shareholder, you have the right to receive dividends once the company announces that it's giving out dividends. So, for example, there are multiple companies that are known as dividend payers, but other companies also pay dividends, for example, if they had a really good year, just as a reward to their shareholders.
What would cause the share price to actually go up or down? Could you give some examples?
Okay, so multiple factors could cause a share price to change. This could be from, for example, a change in market sentiment. For example, people no longer believe in that company, and so they start offloading and selling those shares. And once many people are selling the shares, the price will tank. Or, for example, the government puts in a regulation that we know will adversely affect that particular company. People start selling the shares, the price goes down. Or let's say the company moves or grows. For example, Safaricom moving to Ethiopia, where there's a population of 100 million, or Equity and KCB Bank, which have been expanding regionally. Those are positive things. So investors will start buying up the shares, causing the price to go up. So lots of things could cause the price to change with shares.
Okay, thank you for that. And how much dividends do they typically get?
So dividends, the amount of dividend that you get from a company depends on how many shares you have, first of all. So you're paid per share. And it also depends on the announcement that the company has made in terms of the level of dividend. So, for example, recently, I think Safaricom announced 92 cents per share. So if you have, 100 shares, that would not be much. But if you have 100,000 shares, that should be quite a bit of money coming into your account. So it all depends on the company and also the amount of shares that you own. To conclude, this alternative is ideal because of the higher returns that you get. So as I mentioned, with other low-risk investments like bonds and money market, you'd range between 7% to 15%. But with stocks, you could even go up to 100%. Yes. So, however, there's higher risk with stocks. So the higher the return, the higher risk always in investing. And another benefit of investing in stocks is the quick conversion to cash. So if you want to have an investment somewhere where if there's an emergency, you can always sell your shares and quickly get the money, then stocks would be ideal for you. And because of the higher risk, we also advise people to consult with their brokerage houses before investing in any stock options.
Okay, thank you for that. I think now I have a better understanding of what shares are. I think another question would be, what are derivatives? I think you mentioned that.
Yes, I did mention derivatives at the beginning, and this is, I think, the least well-known alternative investment option, which is very sad.
It's actually the first time I'm hearing about that.
Oh wow, really?
Yeah.
Okay, yes, it is. It is not well known,
Okay.
but it has its key benefits. And before we even go into the benefits, what is a derivative?
Yeah.
A derivative is a financial instrument that derives its value from an underlying asset.
Okay.
So basically, a derivative contract is just a contract, but its value rises and falls based on the assets that it's attached to or pegged to. So for example, if it's pegged to a stock or stocks like Safaricom and Equity, if Safaricom and Equity Bank are doing well, then your derivative contract will also increase in value. That's what a derivative is. And one of the main, because probably you're thinking, okay, why don't I just invest in Safaricom or Equity?
Yeah.
Why would I get a derivative contract?
Yeah.
One of the benefits of derivatives is that they offer leverage, and that's why investors love them so much. So leverage is basically a form of borrowing in investing, where you take a larger position than you can afford at the moment. So if you only have 10,000 shillings, but you're sure that the price of Safaricom is going to go up, you would take leverage of maybe even 5 times the amount and position yourself so that it's as if you invested 50,000 shillings.
Okay.
And so even when the return, when the price of Safaricom does go up, you make 5 times the return than you would have gotten if you invested through the usual means.
Okay.
So that's one of the reasons that investors love derivatives. Yeah. Of course, it's higher risk.
Yeah.
The higher the risk, the higher the return.
Yeah.
But for example, again, please consult your brokerage house.
Okay.
And for example, at AIB Access Africa, we've been the top and derivatives brokers for a couple of years.
That's amazing.
And we're very, very open to speaking to investors and connecting them to our derivatives desk for guidance.
Okay, so an underlying asset can be anything, even property, machinery, or
well, yes, but not in Kenya. So in Kenya we only do stocks and indices.
Okay.
But in case people don't need more information on that, they can always reach out to us and we'll guide them through.
Okay. That was helpful. Thank you for that. I think in last month's video you mentioned compound interest. What kind of investments would earn compound interest?
I love that question because the beauty of the answer is that most investment options can earn you compound interest.
Oh, okay.
So that basically just depends on how you manage your investment. I'll get into that. There are some investments that will state that they earn you compound interest. They're compounding monthly or even yearly.
Yeah.
But you as an investor can take control and actually manipulate your investments in order to earn compound interest every single time.
Oh,
so how do you do that? Exactly.
Yeah.
All right. The definition of compound interest is interest earning you interest, correct?
Yeah.
So if you're receiving any kind of interest or income from an investment and you reinvest that income or interest, then automatically you convert your investment to one that's compounding. Why? Because that income or interest is now earning you interest.
Yeah.
And over time, you'll start to see the difference. So someone else who's taking out the money and maybe using it versus you who's putting it back in, if you're able to, or if you're disciplined enough, then you will see that major snowball effect after a couple of years. So the advice there would be, as far as you are able, instead of taking out the income or the interest that you've earned, put it into that same investment or into another investment in order to achieve that compounding effect.
Yeah, that's helpful. Thank you.
Okay, thank you, Gloria, for being here. That was a great conversation.
Yeah, it was.
And I'm sure it was beneficial to everyone out there who's trying to make the most of the money in their pocket right now. Be sure to give us your questions in the comment section. Let us know anything else that you need us to clarify or chat about in upcoming videos. And please don't forget to like, share, and subscribe. And see you next time.